Charlie Munger is often recognized as the sidekick to one of the world's greatest investors, Warren Buffett. But Munger's story and tips are equally as helpful in understanding what it takes to successfully make money from stocks. So in today's video, we'll be going through how Charlie Munger made money from stocks and how he still does it, and how you can do the same. If you like the sound of today's video, smash that like button and let's get right into it. Charlie Munger didn't have the easiest life when he started in his investing journey. He went through a divorce, his 9-year-old son had leukemia, and his father sadly passed away. Munger met Buffett through his father's acquaintances. When he returned to Omaha to support his family, he and Buffett clicked right away. They talked for hours on the phone about potential investments. Munger gradually rose to the position of business partner and investment counselor in his company, which was previously held by Benjamin Graham, Buffett's mentor and the father of value investing. When the opportunity came up, Munger entered a real estate business by partnering with one of his clients in 1961. He started building apartments that were coming into trend in South California, as the population there started to rise in 1962. He found a new law firm with some of his sharpest colleagues from his old firm too. That year, Munger started his investment partnership, and his first real estate development proved immensely profitable when he sold it in 1967. And he continued to invest in similar projects with various successful partners. His success allowed him to indulge in his passion for architecture, as well as to hone his business skills by spotting real estate friends and introducing new ideas to sell his projects. Many of Munger's business associates eventually became very successful themselves, and one of Munger's firm's early clients was Warren Buffett, along with the companies that later became Berkshire Hathaway. Munger stopped practicing law entirely, almost, in 1965. His firm had the reputation of an intellectual powerhouse. Munger had a company that was a hedge fund that invested in many of the same firms and securities as the Buffett partnership. Munger developed it mainly as a result of Buffett's encouragement. Despite the disastrous consequences of the 1973-1974 stock market crash, Munger averaged a 24.3% annual return from 1962 all the way to 1975. This easily outperformed the Dow Jones Industrial Average 6.4% annual return during the late 1960s and early 1970s. Munger and Buffett gradually acquired a controlling interest in blue chip stamps. This small company had issued trading stamps which merchants distributed. Customers collected and redeemed the stamps for merchandise. The investors saw untapped potential in the company's float account, the difference between stamps issued and stamps redeemed. Using this pool of capital, blue chip's controlling investors acquired several other companies. At first, Blue Chip bought part of the company, but it owned 80% by 1974. The acquisition led to the SEC lawsuit alleging that Blue Chip manipulated West Coast stock to fight off another merger. The suit was settled, and Berkshire Hathaway's dense tangle of ownership interest was subsequently simplified, with Blue Chip becoming a wholly owned subsidiary. Munger was named Berkshire Hathaway's vice chairman, his first formal position within the company. One of Munger's and Buffett's biggest successes was when they invested in See's Candy, and this investment marked the transition in Munger and Buffett's way of investing, as Munger encouraged that they focus on the quality of the underlying business. They weren't going to invest into See's Candy at first because they didn't want to pay more than what they had offered, but then took some constructive criticism and decided to change their minds. Walking away from See's Candy would have been a terrible idea because for them, in 1972, Berkshire Hathaway bought the entire company for $25 million. The story gets better. That year, the company had $31 million in sales and made $2.083 million in profits after taxes. Based on Warren Buffett's valuations of See's Candy, he was initially unwilling to pay more than $25 million that he offered, and that would have proved to be an extremely silly decision. As of 2007, See's Candy had earned Berkshire Hathaway $1.35 billion in pre-tax earnings, so based on this, it was irrelevant whether they paid $100,000, $1 million, or heck, even $10 million more. Since then, in 2019, Buffett said that See's Candy has produced north of $2 billion in pre-tax earnings and that the chocolate company remains a cash cow for Berkshire Hathaway. See's Candy exemplifies what Munger looks for in a business. The company has built a competitive advantage through significant brand and customer loyalty. Long-term competitive advantage in a sustainable industry is what you would seek in a business when it comes to investing. Makes sense, right? This is exactly what Munger and Buffett found, and they saw in See's Candy. The company had limited potential for scaling, sure, but they were able to provide a reliable, consistent cash cow. This mindset of buying great businesses at fair prices shaped many of Munger's future investments. In 1977, Munger's mother passed away, and a cataract operation left him blind in one eye. But this did not stop Munger. In the late 1970s and through the 1980s, having learned from See's Candies that some companies were worth a premium price, Berkshire Hathaway investments included Geico, Dairy Queen, and Coca-Cola. So that's some background on how Munger became a billionaire, despite having to face some devastating blows along this journey. Now, what can we learn from this? Well, Munger's tip number one for investing in stocks is buy stocks that are easy to value. He says, you're looking for a mispriced gamble. That's what investing is. And you have to know enough to know whether the gamble is mispriced. That's value investing. Finding a stock with an asymmetrical risk-reward ratio in favor of the position you want to take in, it is essential to what this comes down to. The stock must be simple to value for this to be repeated and successful. All of this boils down to Warren Buffett's famous circle of competence. While some investors have in-depth knowledge of some complex industries such as semiconductors or biotechnology, it is ideal for the average retail investor who lacks specialized knowledge of technical subjects to stick with extremely simple investments. The easiest businesses to value are defensive ones that produce very stable cash flows, growth within a very predictable range year after year, and then distribute the majority of their cash flow to shareholders via dividends and/or buybacks. This is because there are fewer variables and it's simpler to estimate future cash flows. REITs like WP Carey, midstream energy firms like Enbridge, utilities like Algonquin Power and Utilities, and BDCs like Ars Capital are some of the favorite sectors to mine for these opportunities. This applies to some excellent asset managers as well, such as Blackstone. Munger's tip number two: buy high-quality businesses. Munger says a great business at a fair price is superior to a fair business at a great price. Great businesses make for better investments than fair businesses for two main reasons. Number one, since great businesses by definition have better competitive advantages, using Munger's tip number one is simpler because there's less ambiguity regarding the business's potential future revenue stream. Number two, outstanding companies have a proven track record of developing a superb corporate culture and employee team that can innovate to meet unforeseen obstacles and forge brand new, exciting growth prospects. This is what has fueled the superior long-term performance of businesses like Amazon and Apple. Munger's tip number three: buy businesses that play the long game. He says today it seems like there's a regard as a duty of CEOs to make the stock go up. This leads to all sorts of foolish behavior. We want to tell it like it is. The creation of actual value comes from investing in the long-term success of the business, yet many management teams have become fixated on financial engineering appropriate to placate Wall Street analysts in the short term. AT&T and International Business Machines, IBM, are two terrible examples of this. Both of these firms aggressively repurchase shares at high prices to placate analysts and entice shareholders at the expense of making risky but essential investments in their future. As a result, both companies had slow growth and disappointing results. Shareholders' value was ruined as a consequence. When Munger speaks about investing, people sit up and pay attention. From today's video, you should take away that an investor's evaluation of a possible investment opportunity should be heavily influenced by these three pearls of investing wisdom we just went over: easy to value stocks, exceptional businesses, and playing the long game. So be sure to have these words of wisdom in the back of your mind as you're embarking into your investing today and your whole long-term journey. If you learned something new in today's video, be sure to hit the thumbs up button down below and comment any thoughts or questions that you might have. We're a community helping each other grow. We love hearing from you guys. And if you don't want to miss out on more incredible money-making tips and opportunities, be sure to subscribe to the channel with notifications turned on. You're welcome. See you next time.